Core idea. Markets don't fear bad news. They fear what most people haven't noticed yet. Most people think markets move on news. A headline comes out. Prices react. Fear or optimism follows. That story feels intuitive, but it's rarely how real market moves begin. Markets don't actually fear bad news. They've learned how to price that in. What markets fear is something much quieter, a shift in behavior that isn't showing up on the screen yet. When price collapses, the instinct is to assume something is wrong with the asset itself. That sellers suddenly know something you don't. That value has disappeared. But experienced market participants learn to ask a different question first. What changed underneath the price? Not the headline, not the commentary, not the emotion, the structure. Because when markets truly break, they don't do it loudly. They do it through small disconnects that most people ignore. Between pricing and availability, between paper claims and real-world constraints, between what is being traded and what actually exists. Those disconnects don't scream, they whisper. And by the time they become obvious, the opportunity, or the risk, is already gone. Today's move in silver has been framed as panic, as collapse, as a simple reaction to shifting expectations. But if you slow down and look carefully, something doesn't quite line up. This isn't about predicting where prices go next. It's about understanding what kind of market you're actually in right now. Because the decisions you make in a normal market are very different from the decisions you make in a stressed one. And that distinction matters far more than today's price. On Friday, January 30th, 2026, precious metals experienced a sharp and rapid price decline during the final trading session of the week and the month. Silver prices fell significantly from levels above $120 earlier in the week into the mid-$90 range, representing a weekly decline of more than 20% depending on contract and venue. Gold prices also declined sharply, moving from record highs above $5,600 earlier in January to levels below $5,000 by the end of the session. The majority of these price moves occurred during U.S. trading hours. This marked a notable reversal from earlier in the month. January had been one of the strongest months for silver and gold in recent years, with prices rising rapidly and volatility increasing. Leading into the final week of the month, positioning in precious metals, futures markets had expanded, with elevated open interest and higher margin usage relative to recent averages. The timing of the decline coincided with several market events. January 30th was the final trading day of the month, a period typically associated with position adjustments, future settlement activity, and options-related flows. It also followed heightened volatility across global financial markets as investors reassessed expectations around U.S. monetary policy leadership and interest rate trajectories. At the same time as the price decline, several developments were reported in the physical precious metals market. The Perth Mint in Australia issued a notice to wholesale distributors stating that it would pause new wholesale orders for its 2026 Kangaroo 1-ounce silver bullion coin until late February in order to address existing back orders. The United States Mint temporarily marked several silver numismatic products as unavailable while updating pricing, following rapid changes in underlying silver prices. Reports indicated delivery delays and limited availability for certain silver products from major sovereign mints, including the Royal Mint in the United Kingdom. Physical silver premiums in some regions widened relative to spot prices, reflecting tighter retail supply conditions. Inventory data published by the Shanghai Futures Exchange showed a material daily reduction in reported silver vault holdings. These developments occurred during the same week that paper prices for silver and gold experienced one of their sharpest short-term declines in recent years. No official statements were released indicating a coordinated policy action affecting silver supply or demand. The price movement itself was driven through futures and derivatives markets, where the majority of trading volume in precious metals is concentrated. The significance of the recent move in silver is not limited to the size of the price decline. What matters more is how the decline occurred and where stress appeared simultaneously. In modern commodity markets, price discovery primarily takes place in futures and derivatives markets. These markets are highly liquid, respond quickly to changes in positioning, and are sensitive to macro variables such as interest rates, currency movements, and risk sentiment. As a result, prices can move sharply even when underlying physical supply and demand conditions change more slowly. The first-order effect of the late January sell-off was straightforward. Leverage positions were reduced, margins were adjusted, and short-term traders exited exposure. This process tends to accelerate price moves near month-end, when funds rebalance and risk is reassessed. The second-order effects are more subtle and more important. As prices fell rapidly, the divergence between paper pricing and physical market conditions became more visible. In physical markets, production schedules, inventory levels, refining capacity, and logistics constraints do not adjust instantly to price movements. When demand remains firm or increases while supply chains are already stretched, availability can tighten even during periods of price weakness. This creates a lag effect. Paper markets respond immediately to financial flows, while physical markets respond to delivery capacity and inventory. When both are under stress at the same time, short-term pricing signals may fail to reflect near-term availability. Different participants are affected at different stages. Futures traders and leveraged investors are impacted first, as price volatility directly affects margin requirements and risk limits. Refiners, mints, and wholesalers experience the next layer of impact as sudden price changes disrupt pricing models, hedging programs, and order flows. Retail buyers and industrial users typically experience the effects last through delivery delays, higher premiums, or allocation limits. The widening of physical premiums in some regions during the same week as falling paper prices highlights this sequencing. Premiums do not represent a separate market. They reflect frictions between supply, demand, and delivery timing. When volatility increases, those frictions become more visible. Inventory movements, such as reported changes in exchange vault holdings, matter because they represent actual transfers of metal rather than financial exposure. While inventories can fluctuate for operational reasons, sustained or unusually large changes signal stress in the physical delivery system rather than speculative positioning alone. The broader implication is not that prices are wrong, but that price alone may be an incomplete signal during periods of structural strain. Markets can remain functional while still sending mixed messages across different layers of participation. For investors and observers, the key issue is not predicting immediate price direction, but recognizing that volatility can reveal underlying fragility. When pricing mechanisms and delivery mechanisms move out of sync, risk management becomes more important than directional conviction. Understanding this distinction helps explain why the same price movement can be interpreted very differently, depending on whether one is looking at futures screens or physical market conditions. Periods of sharp price declines combined with signs of physical market strain are not without precedent in commodity markets. While each episode is unique, reviewing similar structural conditions can help separate signal from noise. One comparable environment occurred during the late 1970s precious metals cycle. In the years leading up to the 1980 peak, silver experienced repeated episodes of volatility, including sharp pullbacks that coincided with strong physical demand. In several instances, futures prices moved rapidly while retail availability tightened, reflecting limitations in refining capacity and distribution rather than immediate changes in mine supply. Importantly, those price declines occurred before the widely recognized supply stress became visible to the broader market. Another relevant example appeared during the 2008 to 2009 financial crisis. Silver prices fell sharply during the liquidity shock, driven by forced selling and deleveraging across financial markets. At the same time, physical silver premiums rose in many regions as mints and dealers struggled to meet demand. The disconnect was temporary, but it demonstrated how financial market stress can overwhelm short-term price signals even when physical demand remains intact. More recently, during the 2020 global shutdown, silver prices initially collapsed alongside other risk assets. Physical markets, however, experienced disruptions in mining, refining, and transportation. Retail shortages and extended delivery times followed, even as futures prices reflected broader risk aversion. Again, the key dynamic was not prediction, but recognition that price alone did not fully capture real-world constraints. What distinguishes the current environment from these historical episodes is not a single factor, but a combination of conditions. Industrial demand for silver is structurally higher today due to its role in electronics, energy infrastructure, and advanced manufacturing. At the same time, mine supply growth has been relatively constrained, and inventories accumulated in prior decades have been drawn down over multiple years. Additionally, modern markets are more financialized. Futures volumes, algorithmic trading, and cross-asset positioning now exert greater influence on short-term price movements than in earlier cycles. This increases the likelihood of sharp price adjustments that are driven by liquidity and positioning rather than physical availability. History does not offer a template for outcomes, but it does offer context. Episodes of divergence between financial pricing and physical conditions have occurred before, often during periods of stress, transition, or rebalancing. In each case, the initial price movement alone proved insufficient to explain what followed. The lesson from these periods is not inevitability, but humility. Markets can behave in ways that feel contradictory in the short term, especially when structural constraints meet financial volatility. When markets move abruptly, the most common mistake is to search for a single narrative that explains everything. Professional risk management works differently. Instead of asking what will happen, the question becomes, what could happen under different conditions? Below are three plausible scenarios based on observable market mechanics and historical behavior. These are not predictions. Each scenario depends on specific conditions being met. Bull case, repricing through stabilization. In this scenario, prices stabilize after the late January liquidation and begin to recover gradually. For this to occur, several conditions would need to align. Volatility would need to decline, allowing leverage positions to normalize and margin pressure to ease. Futures markets would need to see reduced forced selling and more balanced participation between buyers and sellers. At the same time, physical market tightness would persist without escalating into broader financial stress. Premiums would remain elevated but orderly, signaling constrained availability rather than systemic failure. Industrial demand would remain stable, and investment demand would normalize rather than spike. Under these conditions, futures prices could begin to reflect longer-term supply-demand fundamentals more closely. Price recovery would likely be uneven and volatile, driven more by reduced selling pressure than by speculative enthusiasm. Importantly, this scenario does not require a shortage crisis or a loss of confidence in financial markets. It relies on stabilization, not acceleration. Base case, extended divergence, and range volatility. The base case assumes that recent volatility was primarily a positioning and liquidity event, not a decisive structural break. In this environment, prices remain volatile and range-bound. Futures markets continue to react to macro variables such as interest rates, currency movements, and broader risk sentiment. Physical markets remain tight in certain regions, but supply chains adapt through rationing, longer delivery times, and premium adjustments. Under this scenario, the disconnect between paper pricing and physical availability persists intermittently. Premiums fluctuate, inventories move unevenly, and availability varies by geography and product type. Neither side fully wins. This outcome would reflect a market adjusting to higher structural demand and constrained flexibility without entering a crisis phase. For investors, this is typically the most challenging environment. Price signals are noisy, conviction is low, and patience is required. Historically, extended base cases often last longer than expected and resolve quietly rather than dramatically. Bear case, macro pressure overrides physical signals. The bear case assumes that broader macroeconomic forces overwhelm near-term physical market dynamics. In this scenario, rising real yields, a strengthening US dollar, or tighter global liquidity conditions drive continued selling in precious metals futures. Financial deleveraging expands beyond short-term traders to include longer-term participants. Physical tightness does not disappear, but it becomes secondary to macro-driven risk reduction. Premiums may compress temporarily as demand softens or buyers delay purchases. Inventory drawdowns slow, and availability improves marginally as price-sensitive demand steps back. This scenario does not imply that long-term fundamentals are invalidated. It suggests that financial conditions can dominate pricing for extended periods, even when physical constraints exist. History shows that commodities can remain under pressure longer than fundamentals alone would suggest. Across all three scenarios, the common variable is uncertainty. None assume perfect information or frictionless markets. Each highlights different transmission mechanisms between financial pricing and physical conditions. Professional analysis is less about choosing a favorite outcome and more about preparing for multiple paths. The goal is not to be right, but to remain solvent, flexible, and informed as conditions evolve. When price action becomes volatile and narratives multiply, the most useful response is to narrow focus. Rather than reacting to headlines or commentary, I concentrate on a small set of indicators that help distinguish temporary noise from structural change. The first is the US dollar index, DXY. Precious metals are highly sensitive to currency movements, particularly during periods of financial stress. Sustained strength in the dollar tends to pressure metals prices, while stabilization or reversal can reduce headwinds. I am less concerned with daily fluctuations and more focused on whether dollar strength is accelerating or losing momentum. Second, I watch real interest rates, particularly U.S. Treasury yields adjusted for inflation expectations. Rising real yields increase the opportunity cost of holding non-yielding assets like silver and gold. If real yields continue to rise, they can suppress prices even in the presence of physical tightness. Conversely, stabilization in real yields often precedes relief in precious metals. Third, I monitor inflation data, especially CPI and PCE releases, not for the headline number, but for trend direction and dispersion across categories. Metals tend to respond more to changes in expectations than to absolute levels. Sudden shifts in inflation trajectories can alter positioning quickly. Fourth, I pay close attention to futures market positioning. Changes in open interest, volume, and the distribution between commercial hedgers and non-commercial traders provide insight into whether moves are driven by liquidation or new conviction. Sharp price moves on declining open interest often signal position reduction rather than structural repricing. Finally, I observe physical market indicators where reliable data is available. Reported inventory changes, delivery delays, and premium behavior. None of these in isolation determine price, but together they help contextualize what futures markets may not fully reflect in the short term. The goal of watching these indicators is not to predict the next price move. It is to understand whether conditions are stabilizing, deteriorating, or transitioning. In stressed environments, clarity rarely comes from any single data point. It emerges from consistent signals across multiple layers of the market. This process helps reduce emotional reactions and anchors decision-making in observable conditions rather than narratives. Periods like this tend to amplify emotion. Sharp price moves invite strong reactions, and conflicting signals create pressure to act quickly. In my experience, that is usually when discipline matters most. Short-term volatility does not invalidate long-term structure, just as temporary dislocations do not guarantee immediate resolution. Markets often take time to absorb shocks, especially when financial positioning and physical constraints adjust at different speeds. The most productive response is not certainty, but preparation. That means understanding your exposure, recognizing the limits of any single price signal, and remaining flexible as new information emerges. Risk management, not conviction, is what sustains participation through uncertain phases. This isn't investment advice. It's simply how I'm reading the market right now, based on observable data and historical patterns. Prices will continue to move. Narratives will continue to shift. What matters most is staying grounded, patient, and focused on process rather than prediction. That approach doesn't eliminate risk, but it helps prevent avoidable mistakes when markets are under stress.